WIP, profit and cash flow. Very important topic because in my experience, focusing on the right things in your business will enable greater opportunity to produce the outcomes that you want. And what I find in firms is that they're spending their time focusing way too often on the things that they shouldn't be focusing on. And often it's not that key driver that really will make the difference. So all of these three items are very important. WIP being work in progress, profit and cash flow, but there's only one of them that drives everything else in the business. And that's what I'm going to share with you today and give you some insight into why that one is so critical. So when you registered for the webinar, we asked you all, in your opinion, what's the most important driver of law firm financial success? And you said 61% cash flow, 25% profit, and 14% WIP. I must say that was exactly what I was expecting in terms of the responses, simply because that's what I often see with firms. Is I often see this absolute focus on cash flow and this drive, so managing their cash flow and profit, not so much just sort of leaving that up to chance and seeing what happens, but very rarely do firms focus on their WIP. Okay, so what's WIP? So WIP is the dollar value of work done but not billed. So your work in progress, the timesheet entries at charge rates that haven't yet been billed to clients. Profit is the dollar value of work done and billed minus the dollar value of expenses. So where WIP is the dollar value of work done but not billed, profit is what you billed minus your expenses. Okay, that's pretty basic. Cash flow, though, is different again. So, often I get asked the question, well, you say we make this amount of profit, but where is it in cash? And that's because cash flow is equal to the work done, dollar value of work done and billed and collected. So not just work done and billed, but work done, billed and collected, minus the dollar value of expenses paid, minus the dollar value of tax paid if you're a company, minus the dollar value of loan repayments paid, minus the dollar value of unbilled disbursements that you've paid that you haven't yet billed, minus the dollar value of whatever else you've paid, purchasing some fixed assets or whatever those other cash outflows are that don't fit within any of those categories I've listed there. So you've got three distinctive components to looking at your financial performance in your business. What's your WIP, what's your profit, and what's your cash flow? But there's only one thing that is consistent with all of them, and that's the dollar value of work done. So WIP, dollar value of work done, profit, dollar value of work done and billed, and cash flow is the dollar value of work done, billed and collected, then minus everything that comes out of that. So when you're focusing on your business and you're wanting to focus on getting some different results, first and foremost, you must focus on work in progress. Work in progress has all of the key ingredients in it that enable you to produce predictable outcomes if you're focusing on the right things. So WIP by far is the most important. I shouldn't say by far. I think it is the most important because what it does is drives your profit and cash flow. Your profit and cash flow is also very, very important. So today we're going to be focusing on WIP. So I asked you the question, where's your focus when you think about it in your business? And is it on your collections, which is your cash flow? Is it on your billing, which drives your profit? Or is it on your work in progress, which is the driver of profit and cash flow? So just stop and think about that for a moment. So where do you put all your energy in? Where do the people in your energy, where do the people in your business put their energy in? What's driving the day-to-day activities of your business? Because where you focus on will drive those outcomes. So if you're looking at what your outcomes are that you want to achieve, and let's say your outcome is I want to improve my cash flow, and that's what you're focusing on, and I just want more cash flow. So you look at the behaviors of the business, and if you're a bit cash flow strapped, often the behaviors of the business are very much focused on just getting those bills done and out and collected. You're forgetting about what are the drivers of actually producing that revenue, and which is doing the work. So if you want to look at what drives your outcome, it's the behaviors of the business. And what drives your behaviors in the business is the systems and structures that you have. So for example, if you want to get improved profitability, you need to make sure you're maximizing your revenue and minimizing your expenses and finding the right balance in that respect. But you've got to then have a look at what the behaviors are around maximizing revenue, for example. And if within your business you're not focusing on making sure that there's good workflow, if you're not focusing on your billing processes, if you're not focusing on your time entry processes, then the behavior of the business may be one of a discretionary nature, which means you're going to produce unpredictable outcomes. So really focusing on that structure in your business to drive a change in behavior or produce the behaviors that you want is critical for producing the outcomes that you desire. So I'm just going to take this another little step forward further, in that our behaviors very much in our business are driven by our feelings, and feelings in business are driven by your thoughts. So for example, if your focus in your business is on one of a cash flow focus and constantly chasing your tail around cash flow, then your focus or your view on cash flow and its importance and the context that you give that will drive your feelings. If it's constantly coming from a place of scarcity, we don't have enough, how are we going to pay the bills, then behaviorally that is going to drive certain outcomes in your business. So what you've got to do is you've got to actually go back and look at what the structure is. What should I be focusing on? What structure do I need to have in place? What do I think about that? That's going to drive the behaviors that produce the outcomes that I want. So I'm going to share a bit more detail with you on that in a moment. So if you think about it, where's your focus? So generally I find in firms where they've got a very high focus on cash flow, where the conversations that you have with them around how's your business going, they say, oh, receipts are good. We've got our receipts. It's all about receipts. It's not about the key drivers of profitability. It's about receipts. And often that is driven because of some historical cash flow shortage or for a poor funding plan. And what I mean by that, a poor funding plan, is often where you've got firms that need to manage significant dollars of deferred matters where they can only really bill at the end of that matter, which often is the case in a family law property settlement where there's no cash available, or maybe in an estate administration where there's only a property to sell, where you've got to wait for that, or a personal injuries firm. So a poor funding plan is when you haven't got in place sufficient cash, well, not really cash, but sufficient debt to be able to manage that delay in billing and cash flow. But the first point in that comment there about it's often a result of historical cash flow. Firms often always go through some sort of a cash flow crisis, but that sometimes and often is just a blip in time, unless it's a systematic cash flow crisis that they're always in. But if a firm's in a bit of a cash flow crisis and they focus heavily on their cash flow in that time to get them out of it, the behaviors of that firm often carry through so that they're focusing in purely on that cash flow day in, day out, which means they're not doing the things or focusing on the things that really will drive better performance. So the feeling that business has in those cases is often one of fear, and it's scarcity based. So they're constantly chasing their tail. You don't ever feel like you're making any progress. You're always worried about whether you can pay the bills. So behavior often then is daily monitoring of bank balance and projecting if there will be enough to pay future commitments. So the key to that, to get out of that, is actually focusing on what drives those cash flows, what drives the profitability. And as I'll show you shortly, it comes back to the work in progress. If your focus is on billing, which is profit, so remember that your profit is equal to your WIP that is done and billed minus your expenses that you've incurred. So when you're focusing on billing and profit, it is a much closer step to WIP, because what you're focusing on is what we've got to do is get those bills out. Because if you're not getting the bills out, then you're not going to get the cash flow anyway. But if you're focused on you end up looking at systems and processes that improve your billing, and that gives you a closer step to, or makes it a bit easier, I suppose, to produce those better profit outcomes, which will produce a better cash flow outcome. So your focus is on getting the fees done, but often I find where just billing is the focus in firms, they're frustrated because it's difficult to hit the fee outcomes. And usually that is because they're just leaving it up to their fee earners to do the work. They're often leaving it up to their fee earners to just generate and determine when a fee is going to be billed. But there's no focus on the actual workflow and the work that is being done and how that translates into revenue. So the behavior often is it's a big push to get fees done at the end of every month. And, sometimes that's just banging the drum to get everybody to do their fees. Sometimes that is just principals really, knuckling down and doing the majority of fees themselves so that they know that there's going to be some sufficient cash flow there out of the profits that they make. So just by focusing in on billing by itself doesn't give you the greatest probability of really improving your financial outcomes. But WIP's the key. And the key to WIP is focusing on daily time entry. Now, you would have, you'd be listening and go, yeah, we keep focusing, getting our team to focus in on entering their time daily, having those conversations, be better off just going smashing my head against a brick wall because I'll probably get the same outcome. But there are some key focuses and key activities that you can implement to really shift the focus of the entire business on what you want your key people, your fee earners, to be doing. And if you can achieve that really strong focus on daily time entry, so effectively on the amount of work that is actually being done on client matters, over time, you get this feeling of confidence as WIP accumulates, because ultimately the amount of fees that you bill is a function of the work being done. Now, you might bill an amount based on a fixed fee, or it might be on a time basis, but ultimately it's all driven by work being done. So work in progress or time entered into WIP is the key driver. It's the number one thing that if you get it right, the behavior ends up being individual accountability for achieving firm-wide fee targets. And that's the key. You've got to really be looking at what you've got to do to break this down so that on an individual by individual basis, people are hitting their daily time entry hours, not necessarily dollars, but they're just daily time entry hours. Because that's all you require of them, because that's what drives your billing. That's what can ultimately drive your improvement in profit and improvement in cash flow. So let's take that a little bit deeper. And let's look at key performance indicators and what they are. So a key performance indicator is simply, it's a measure of a critical activity. So going back here again, where's your focus? What are the activities that your focus is driving on the business? So what you need to do is you need to understand the key performance indicators, the KPIs of the business that measure those critical activities that drive improvements in profitability and cash flow. And there's not too many you've got to worry about. There's a lot of stuff, there's a lot of activities that the business does, but if you focus on some key, a small number of KPIs that measure those critical activities, you can get really good insight into what you need to do. So those two critical KPIs are average rate, which measures the dollar of revenue for every direct labour hour paid, and it's calculated by looking at your revenue divided by your paid hours. So your revenue being what you actually build, and your paid hours are those direct labour hours that you pay whether someone's at work or not. And therefore, equity principals, solicitors, legal support people. You generally, you exclude your administration people, practice managers, or your accounts team, or your receptionist. The paid hours include any of those people that are directly working on client matters, whether they charge any time or not. That's the cost of generating that revenue. And so the relationship between paid hours and revenue is the critical number that you need to know, and you need to be able to drive an upward trend in. So that's the first critical KPI. The second critical KPI is your revenue lockup percentage. And your revenue lockup percentage is equal to your revenue divided by your work in progress balance plus your debtors balance combined. So if revenue was oh my goodness, I've just put that totally around the wrong way. It's your work in progress plus your debtors divided by your revenue. So if your work in progress and your debtors was $1 million and your revenue was $2 million, then your revenue lockup percentage is 50%. And what that means is that measures the percentage of your revenue that you've earned and billed or unbilled, so total amount of what you've billed or you haven't billed that hasn't yet turned into cash. Okay, so if you're focusing on strategies for improving your cash flow, what you need to do is you need to drive your WIP and your debtors numbers down whilst you're increasing your revenue. And if you're increasing your revenue by driving strategies to increase your average rate, then you're going to, one, improve profitability, and then two, improve cash flow. So again, my apologies there. It's pretty fundamental. What a mix-up. So if you want some more details and information on average rate and revenue lockup percentage, go to our website, fwoca.com.au/financial insights. And in there, you'll see a number of different webinars on each of those topics and all other past webinars that I've run, so that where I go into a lot more detail on what strategies you can implement in your firm to drive improvement in each of those KPIs. So I just want to dig a little bit deeper into average rate KPIs, just so that we've got the full context here. And there are two more average rate KPIs that you need to be focusing on. And these are directly then related to WIP. So the first one is your productivity percentage, and productivity percentage is equal to your billable hours divided by available hours. Yes, I've got that around the right way. Your billable hours are those hours that when people, your fee earners work on client matters that they enter on their timesheet, and available hours are the hours that they're at work. So what you're wanting to do is you're wanting to maximise the number of billable hours when people are at work. So it ignores leave and so on, a bit different to your paid hours calculation. And this is like your 5 or your 5.5 or your 6 or your 6.5 billable hours that are your expectations that you have for each fee earner. So it's really important that you start getting a focus and measure that, because what it does, it measures the activity of time entry. Now, when you're talking with your team members about what they need to focus on, you're best not to talk about dollars. You're best just to talk about them hitting their billable hours, which I'm sure you do. But when it keeps getting, when you keep focusing and seeing trends in this productivity, then you've got to stop and think, well, what are the different strategies we've got to implement to drive an improvement in productivity? Because an improvement in productivity produces a direct outcome of more time entered into WIP, which maximizes the possibility of that being billed. The second average rate KPI that you also need to focus on is then your write-off percentage. And your write-off percentage is simply the dollar value of WIP that you've written off divided by the total amount of WIP done on that matter. So WIP plus the write-off, WIP billed plus the write-off. So that gives you your write-off percentage. And what it measures the success or otherwise of your client engagement to fees billed. Now, that's a very important factor because usually what I see in firms is very poor client engagement. Often sending a cost agreement out, happens most of the time, but it's that engagement during the job, during the matter, during the work being done that isn't focused on. And if you've got a client that's engaged with you, not just around the work that you're doing, but the time that it's actually taking, understanding that in most instances in your cost agreements, it's just an estimate that you provide. If you're needing to re-engage those clients, and you do that on the way through, it's always easier to bill them at the end, where if there's no re-engagement, that's really what drives write-offs. So one, poor pricing at the front end, and then two, not repricing as you're going through. So your productivity percentage is a direct measure of the activity of time entry. If we can get improvements in productivity, it means we get improvements in time entry, it means more WIP. If we've got better client engagement that's happening and tighter billing processes, then we get less of a write-off, which generally means our clients are more closely aligned and engaged around what they're going to be billed. So let's look at revenue, meaning fees billed. So revenue is calculated in your firm using this formula. And it doesn't matter whether you're issuing fixed fees or whether you're doing time-based billing. A fixed fee or a time-based billing uses exactly the same, ends up in exactly the same outcome. You have a rate that you generate, you have a rate that you recover for all of the hours that are worked on that matter, whether it's time entered or not. It's an amount of revenue you get for the hours worked. So revenue is calculated as billable hours, which is your available hours times your productivity percentage. So how many hours multiplied by a charge rate, and the combination of all of the people that have been working on that matter produces your dollars that are added to WIP. So those dollars that are added to WIP are then multiplied by a recovery rate, which is equal to 100% minus your write-off percentage. So if you've written off 10% of the WIP that's been done on that matter, then your recovery rate is only 90% of the time that's been added to WIP, which gives you your revenue. And so therefore your revenue is always going to equal the amount of WIP that's actually billed. Okay, so if the WIP added was $10,000 and you've only billed 9,000, you're 10% write-off. You got a recovery rate of 90%. If we're thinking about how we drive improvements in profitability, we can get improvement in our productivity and reduction in our write-off percentage. What it's going to do is it's going to drive an improvement in our average rate because we're generating more revenue for every hour that we're paying people, which then produces more profitability in relation to the labour costs that we employ. And then provided we're collecting it at the fastest time possible, we are then improving our cash flow. So let's extend this formula here into the cash side of things. So by driving improvements in profitability, we're going to drive improvements in cash flow when it gets collected. So let's have a look at the cash gap and look basically what the cash gap is. It's the time that it takes between a cost agreement is signed and when you start working to when that cash is collected. So again, going back to what the most important thing is in the business is focusing on that activity that drives work in progress. If we focus back on that, then we're going to get improvements in cash flow. Let me show you why. So this period of time between when a costs agreement is signed and when the work is ultimately finished and billed is your work in progress. It's your WIP. It's your time entry. It's the record of the time spent at $1 rate per hour to get that work done. So at a point in time when that work is finished, your final bill for that work is done, and then it goes into debtors. So if we go back to that revenue percentage, lockup as a percentage of revenue, the total amount of your revenue generated happens at this point in time of billing here, and clears your WIP out, but then it goes into debtors. But if you look at all of your matters and you think about how much revenue is being billed, we've also got all of this WIP and debtors sitting in here that hasn't yet turned into cash, which only happens right here at the end. So if you look at the driver of what's going to drive better cash flow in your business, the driver of cash in your business ultimately starts with WIP. It can't turn into cash until you've raised a bill, so it's got to get into debtors, and then at a point in time in the future, you're going to get that turn into cash. So the key strategy for driving improvement in cash flow is drive improvement in WIP, bill at the earliest time possible on the job, on the matter, which doesn't necessarily mean it has to be at the end. It can be on a monthly basis. Get that bill into debtors and get it collected as fast as you can, which might be focusing in on your trust policy or in your collection strategy. But what we want to do is we want to shorten that cash gap. We want to get that period of time down as low as we can between when we collect the cash and we get that costs agreement signed. Because what that does, it maximizes your profitability and it maximizes your cash flow. But again, you look at this and you look at the driver of your business in terms of both of those things, profitability and cash flow. It's got to be WIP. It's workflow. It's doing the work, assuming you've got enough work to do, of course. So let's look at those two critical KPIs. And again, I'm not going to apologize here. I'm sure I've copied the same slide and I've put the wrong formula in, and yes, I have. It should be WIP plus debtors divided by revenue for revenue lockup percentage. But if you look at in both of those KPIs, what the common element is, it's revenue. So again, sorry, revenue should be the other way around at the bottom. But revenue is the key number. So what revenue is, it's the amount of WIP build. Okay, so to drive these two critical KPIs to improve cash flow being your average, improve profitability being your average rate, and to improve cash flow being your revenue lockup percentage, revenue is the key. And the key driver of revenue, if I go right back here, is WIP. Your number of billable hours multiplied by your rate that's added into your WIP. So WIP is critical. Okay, so what are the rules? So I've given you a little bit of an insight, I suppose, there in terms of why work in progress is the most important thing that you've got to start with as an activity for getting drive improvement in your profitability and cash flow. But you've got to also think about where you start and what you're going to be focusing on. And these are 3 rules of strategic change that I use. And if you go back and have a look at any of my webinars or look at anything that I've really written over the years, it always comes back to these 3 rules. The first one is the Serenity Prayer, which I'm not a religious person, but the Serenity Prayer is very useful in life, and it's also in business. And what how it goes is, grant me the serenity to accept what I can't control, the courage to change what I can, and the wisdom to know the difference. So when you're thinking about what you've got to focus on in your business, only focus on what you can control. Okay. So if we're talking about time entry, for example, you cannot control time entry that your employees put in, but you can control how you educate them, you can control how you report back, you can control a whole bunch of things that are around that. You can control how to make it easier for them to time record. So, for example, if you're a My Times user or a Smokeball user or an Evolve Go user, they've got some great tools, functions in those applications that track and summarize activities in a day that make timesheet entry a lot easier, maximizing the probability. So you can control, the technology that you use. The second rule of strategic change is Einstein's definition of insanity, which is doing the same thing over and over again and expecting a different result. So instead of just bashing your head up against the wall, think about to get better time entry in your business. Think about what other activities you can implement in your business. So you got to do something different to get a different result. And lastly, you need to focus on the majority. So most systems in a business focus on the minority. They focus on those things that are designed to keep the minority at bay. And often in firms, it's a minority of people that don't do what's required of them in terms of their work output or their time entry recording. But we seem to spend a whole lot of energy and output focusing on those people. Whereas if we spend the time on the systems and processes that support the people that are doing the right thing and want to achieve and are aligned to the business, then we're going to have a greater probability of producing better results. So focus on those three things. So what are the key WIP systems? So the first thing is fee earners education. So these are the things that you really need to be focusing on within your firm to get improvement in WIP. I know from my experience in working with firms is that principals of firms think that their employees understand the financial mechanics of how their firm works. Do your work, do your timesheet, and it produces this outcome, and that's what's expected of you. But there is next to no financial education that is provided to fee earners within a firm around how the financial mechanics work, let alone understanding the impact that they have by not doing what's expected of them. I wrote an article once called "Discretion is a Profit Killer," and the more discretionary behaviour that you have in your firm, where you're just leaving it up to fee earners to do what they think and work out what they should be doing, the more discretion they have, the harder it is to get a predictable result. So the key is to educate them. They need to understand what WIP is. They need to understand the concept of WIP and then the personal impact that has on firm-wide results. Work in progress, time entry is not raising a fee. But in most fee earners' minds, then I'm determining at that point in time whether I'm going to bill the client or not. That's not what time entry is about. Time entry is nothing more than understanding the amount of work that has been done on a matter. Nothing more, nothing less. Billing is a separate function. The work in progress should be used as a guide to billing and other things, but at the point in time of billing, that is a separate activity of the business. And as a business owner, any principal needs to know, how much time are we spending? Is our pricing right? Are our systems not working? What's going wrong? And unless you know that, it's hard to make a decision. So it's getting a shift in your fee earners' minds and just really the context, their understanding of what WIP's about, to shift from this is so we just know how much time is being spent. It's not about personal monitoring and performance. All it is about, you're busy, you're doing all the work. We just need to know how much time is being spent, and then we can determine what's going to be billed on it. Secondly, it's about the focus. The focus for your fee earners needs to just be on daily timesheets, on billable. I prefer to call them chargeable hours, not billable hours, but in the legal industry, it's all called billable hours. But they need to just focus on daily timesheet entry plus billable hours expectation, not monthly billing targets, because the activity that you want to be focusing in on is enter the time for the work that you've done. So a key element of that is timesheets must be done every day. That is just non-negotiable. That is how it needs to be. If you maximize your output of timesheets being done every day, and the majority of people do that, you're going to maximize the opportunity for collecting all of the work into WIP that is actually being done. It also, if you have that as a policy and you have it as as being a mandatory activity, and you make it visible for your team as to how they're going in terms of just their hours, then most people self-regulate. Most people will achieve that. It's actually okay to go and enter all the time on a job. The only things that you shouldn't be entering on that job, on that file, are preparing cost agreement, raising a fee if you're involved in it, and answering any fee inquiries. Everything else is just doing the work. Whether you bill it is a different question. The second key WIP system area is around client engagement, and this is one of the most important, and why WIP is so important. So with your costs agreement, making sure, which I'm sure you do, you've got your scope, your estimate, but this point here is critical. You've got a re-engagement approach, which basically is just saying to the client and making it really clear with them, the estimate is an estimate to do this work. If it's going to be more or it's going to be out of scope, we will contact you to do so, to let you know. And that re-engagement is the critical process around of improving your write-offs of work done. And it's simply because clients who have been re-engaged, meaning that the estimate was 10,000, but we now know that we've got a system in the business that says when WIP hits 80% of what's been billed and of what's been billed and sitting in WIP versus that estimate, then we're going to have to look at that, and if we need to re-engage a client, we will. So the client then knows that estimate then goes from $10,000 up to $12,500. So when they get a fee for $12,750 when the matter's over, or that that final bill is rendered, they're not surprised. But where write-offs occur is where there's no re-engagement, where it actually takes a lot more time, which it often does. So we just have this behavior of, let's write it off. And if we just write it off, then we're just letting that revenue go out the door. But more importantly, it's not just the write-off. Usually what happens is that there's a bunch of time that's also been spent on that client matter that hasn't even entered into WIP. So client engagement and re-engagement are critical components to, one, reducing write-offs, and two, to make sure that so that your fee earners can see that, well, clients actually expect, their expectations are that it's going to cost me more, and generally clients are happy to pay in the vast majority, because they don't know what they don't know, and that's why they're asking you to do that work. The other key reason for your WIP system, another key WIP system that you've really then got to focus in on and get systematically working in your business, is your billing process to drive improvements in profitability and cash flow. And that's turning your billing into an administration function. So you remove fee earners' discretion from determining when a fee is going to be raised. In my experience, fees fit into one of three categories. First of all, there's a deferred matter, which should be, unless you're a PI firm, they should be kept to a minimum, because that requires other funding activities to happen in your business. But you've got a deferred fee matter. That means you just bill it at the end. You've then got a staged billing matter, and that staged billing type is where there's an event occurs. So take for example a a family law matter where you choose to structure your fees at certain points in time when work is being done, maybe, or alternatively, where you are, or say on a criminal matter where your fees always get raised straight after you've had a mention in court or appearance in court, or alternatively, you're an estate matter and the fee gets raised on the granting of probate, and then the stage fees after that occur when there's sufficient cash in trust to be able to generate a fee to be paid from. So that's what stage matters are, and everything else should just be a monthly fee. So if you can turn your billing, if you can categorize your matters into one of those three categories, then you can turn your billing into an administration function by reference to your estimates and your re-engaged estimates from your systems. You can also you also know the timing of when a bill is going to be raised, say from a monthly point of view. This particular matter is billed in the third week of every month because that's the week where that particular fee earner does all of their fees instead of leaving it all until the last day of the month. So you can remove that discretion by having your drafting of fees occurring within administration. And then you should be applying the rule. If it's in WIP, it gets billed. And that's because if you've got a really tight and strong re-engagement process whereby clients are being re-engaged when their WIP is hitting 80%, say, of the estimate, or when you're knowing that a matter is going out of scope, then your billing is just an automatic function because what's in WIP is the work that's done and it should be billed and clients have been engaged. So that sort of brings me to the end of today's webinar, and my objective from today was to impart on you the importance of work in progress. Work in progress is absolutely critical to driving improvements in profitability and cash flow, because the activities that drive time going into work in progress, being time entry and workflow, and then the billing of it out of work in progress, are the key activities that produce profitability and cash flow. So that's where you need to spend your initial focus on. Implementing systems within your business that you can control, that are going to produce a different outcome, that impact on the majority of transactions that occur, being most of the invoices and most of the time entries. If you can focus on that, then you're going to get a better outcome, or a different outcome at least. So hopefully you've got a little bit more of an insight into the importance of WIP. And as always with all of our webinars, the first 5 to email me at matt@fwaca.com.au. I'll organise for a free 45-minute online meeting to discuss with you any issues or any concerns, or provide you with any feedback on what you can do within your business to improve your profitability and cash flow. Again, if you've got any questions, please include them in the Q&A section, and I will come back to you by the end of the day on my thoughts around those questions. So thanks again. Keep an eye out for next month's webinar, which will be focusing on the efficiency factor, which is understanding the relationships between the capacity revenue that can be generated in your business and what you're actually generating as revenue, and what the actions are that you need to do in your business to close that gap to produce more profitability. So thanks again. My name's Matt Schlyder from FWA Chartered Accountants. See you again soon.